Therefore, if individuals in the country, if individuals, firms, and governments want to purchase more goods and services, even though the prices of these goods and services have not changed, then we say the aggregate demand has shifted or has increased, which means it has shifted to the right. Also, if individuals, businesses, and governments wants to purchase fewer goods and services, even though the prices of these goods and services or the price level, have not changed, then we say the aggregate demand, has decreased. That is, it has shifted to the left. Okay, so that's why we drew the graph to show the shifting of the aggregate demand, even though the price level did not change. So let me summarize by saying that the quantity demand of GDP, it changes, okay, when the price level decreases. Also, it changes when the aggregate demand changes, even though the price level did not change. Now, remember that the total expenditure consists of the components of spending, which are consumption plus investment plus government plus net exports. Plus net exports. That is, total expenditure is equal consumption plus investment plus government expenditure plus net export. Okay? Net export, which is, as you can see, net export, where net export is equal exports minus imports. Minus imports. Okay, now, of course, we can relate the components of spending to aggregate demand. So we say that if at a given price level, consumption increases, investment increases, government expenditure increases, net export increases, then aggregate demand increases. That is, it shifts to the right. If at a given price level, consumption decreases, investment decreases, government expenditure decreases, net export also decreases, then aggregate demand will decrease. It shifts to the left. Okay. So we said that if at a given price level, consumption increases, investment increases, government expenditure increases, and or net export increases, then aggregate demand will increase. And of course, if on the other hand, consumption decreases, investment decreases, government expenditure decreases, and or net export decreases, of course, at a given price level, then aggregate demand, the expectation is that aggregate demand will decrease. So the question is that here, what causes consumption to change? What causes investment to change? What causes, government expenditure to change? Or what causes, of course, that export to change? So now we have to look at the factors that, can cause consumption to change. And when consumption changes, then aggregate demand will change. So now let's look at the factors that, can change consumption. Okay, so here, factors that change consumption. Factors that change consumption. Okay, so first we're going to look at, of course, 4 factors that are that usually affect consumption. Okay, so now we know that when consumption, let's say, increased, then aggregate demand will increase. So now the question is that what causes consumption to change? So now we have to look at the factors that can change consumption, okay? And as a result of that, aggregate demand will change. So the first factors, of course, we're gonna say it is wealth. Wealth, as you can see, consumption not just depends on income, also it depends on wealth. Of course, wealth is the sum of the assets that a consumer has. It consists of his cash money, his money in his account in the bank. It consists of his ownership of real estate, of cars. All this is the sum of his assets as well. So consumption, also depends on wealth. So let's say 2 persons, each one earns, let's say $15,000 as income per month. However, one of them has, let's say, $50,000 in his as an asset in his account in the bank. So the expectation is that the one who has that amount of money in his bank, $50,000, even though he has the same amount of income with the other person, the expectation is that the one who has that amount of wealth, is willing to spend more than the other person. Therefore, when wealth, increases, then consumption will increase. And when consumption increases, then aggregate demand will increase, which means aggregate demand will shift to the right. So when wealth increases, that implies consumption increases. And when consumption increases, then aggregate demand also increases. And when it increases, it means aggregate demand shifts to the right. The same thing. When wealth decreases, you don't have that much money in your account in the bank. You have nothing. Just, depends on your income. So when wealth decreases, then the expectation is that you don't have that motivation to spend more. Therefore, your consumption will go down. Consumption, of course, will go down. And when consumption decreases, then aggregate demand, of course, will decrease, which implies aggregate demand will shift to the left. Shift to the left. Okay? Shift to the left. We talk about this way here. This is aggregate demand. This is the price level. This is the quantity. Of course, this is aggregate demand. So here, a shift to the right, it means go this way. Okay? And over here, this is aggregate demand. Here, GDP, price level. So it shifts to the left. Okay? So the second factor that can cause consumption to change is expectation about the future prices and income. Expectation about future prices and income. If, for instance, I'm shopping for a car, and there is an expectation of higher prices of the car next 2 months. So that basically encourages me to purchase the car now, which implies the current consumption will increase. Why? Because I expect the price of a car to be higher next 2 months. So why not buy it now to take advantage of the lower price? Therefore, we say an expectation of a higher price in the future means your current consumption will increase, which implies aggregate demand will increase, which implies it shifts rightward. Same things, an expectation of a lower price in the future. That implies if I expect the prices of a car that I'm shopping right now, I'm looking for a car to purchase. If I expect that, I have the news that the expectation is that the prices of car will, become cheaper next couple of months. So what I do now, I don't buy the car now. I just wait, wait 2 months or 3 months in order to buy the car. Therefore, here it means my current consumption will go down, which implies aggregate demand go down, which implies it shifts leftward. Okay. Now, a third one, of course, an expectation of future income. An expectation of a future income, of a higher future income. If I expect my income to go up next, next year. Now we are, let's say, in the about Christmas. So the expectation is that next year, in January, my income will go up 50%. So what that motivates you, encourages me to spend now because what? Because I expect my income to be higher. So now an expectation of a higher future income that encourages me to spend more now. So consumption increases, which implies aggregate demand increases, which implies it shifts to the right. Same thing here. say an expectation of a lower future income implies if my income is going to go down, you know, next semester or next this coming 2 months or 3 months, then this, of course, make me worry, and so therefore it does not, you know, encourage me to spend money, to spend more money. Why? Because my income is going to go down, so my consumption definitely will go down. So here I say that my consumption goes down, and that implies aggregate demand will go down, and this implies, of course, aggregate demand, it shifts leftward. Another factor, of course, that you know, concerns consumption is the interest rate. Interest rate, you remember that the purchase of durable goods such as a mobile, a refrigerator, a car, usually individuals get a loan from a bank in order to purchase these durable goods. Therefore, when the price of the loan, that is, the interest rate is higher, that means individuals will get lower loans, less loans, and therefore consumption will go down. So higher interest rate, it means you consume less. So interest rate R here, interest rate R. So R goes up, that implies consumption decreases. When the interest rate, you know, is up, that means the monthly payment on the loan that you will, you know, borrow from the bank will go up. Therefore, you will consume less. You will get lower loans, okay, which implies lower consumption. So consumption goes down, which implies aggregate demand will decrease, and that implies it shifts to the left. If interest rate is lower, of course, that will encourage you to take higher loans, more loans, okay, from a bank, which implies more consumption, and that implies higher aggregate demand. So that implies consumption increases, which implies aggregate demand will increase. That implies it shifts to the left, to the right. Another factor that is important for learning about the consumption is the of course the personal taxes that individuals pay on their incomes. So here we're talking about the personal taxes. Okay, fact of course number 4 is taxes. Personal tax. Remember that the disposable income is equal in the income for taxes minus taxes. Minus taxes, okay? Okay? So, when individual pay higher taxes, higher personal tax on their income, it means this relation over here, as you can see, when taxes up, that implies YD, which is disposable income, which is equal Y minus T, of course, is going to go down. Taxes going up, that means YD goes down. So disposable income, the income after taxes is down. Therefore, its consumption or the consumer's consumption will go down because the after taxes income, of course, is going to be less. Therefore, the person, the consumer, is going to spend less. Therefore, when taxes goes up, that implies YD goes down. That implies consumption goes down. That implies aggregate demand down, which implies it shifts to the left. When taxes that a person pays is down, okay? Taxes is down. Therefore, that makes your disposable income to be higher. That implies YD is going to go down up. YD, which is disposable income, which implies when your disposable income, is higher, which implies that your consumption is higher. That will encourage you to spend more because your after-tax money or income is higher. Therefore, that will encourage you to spend more. And when your consumption goes up, that implies aggregate demand will go up, which implies it shifts to the right. Okay, now we move to talk about investment, which is part of the aggregate spending, because aggregate spending or aggregate demand basically consists of consumption plus investment plus government expenditure plus net exports. Okay, therefore we talked about consumption. Now we talk about investment. We said before that when investment changes at a given price level, then aggregate demand will change. So let's look at the factors that can cause investment to change. So now we look at, of course, factors that change investment. Investment. Okay? Factors that can change investment spending. Investment spending. Here we look at three important factors. The first factor is the interest rate. Interest rate. Remember that usually businesses get, borrow loans from banks in order to engage in any investment project. So when interest rate is up, it's very high, that implies the cost of any investment project is high. So that will cause firms to invest less. So here, when R is up, that means cost of investment project is high. This implies investment spending is going to be investment it's going to go down. Investment spending is going to go down. And when investment spending goes down, that implies aggregate demand will go down, which implies it shifts leftward. Shifts leftward. As you can see, we already discussed that. This is price level, this is point demand of free GDP, and this is aggregate demand. So it shifts leftward this way here. Same thing when R going down, that implies cost of any investment project will go down. Cost of investment project is low, which implies that will encourage a firm to spend more, to invest more. That implies investment will go up, which implies aggregate demand will go up, which implies it shifts to the right. Okay, shift to the right. Now, another factor that can affect investment is expectation about the future sales. Expectation about future sales. Remember that firms invest because they look at in order to sell their products. Invest about anything, of course, in order to sell their products. So if firms are optimistic about their future sales, then firms will invest. However, if firms are pessimistic, about their future sales, then they won't invest, or they want to invest less. So now here we're talking about if firms are optimistic about future sales, then they will invest, which implies I goes up. And that implies aggregate demand will increase. Now, if firms are pessimistic about future sales, then they will decrease their investment, which implies here investment goes down, which implies aggregate demand decreases. Okay, now the third factor that will affect, of course, consumption is business taxes. Now, of course, firms look at their after-tax profit. If after-tax profits is lower, then they will invest less. So business taxes are, firms make decisions based upon the taxes they have to pay. Okay, if after-tax profits are higher, then they will invest. if after tax, profits are lower, then they will invest less. Therefore, higher taxes means lower profits, which implies investment goes down, which implies aggregate demand will decrease. Lower taxes, lower business taxes means that higher profits, higher after tax profits, which implies that will encourage firms to spend more. That means to invest. Invest will go up, which implies aggregate demand will increase.